So the central banks, by virtue of their monopoly of currency, were able to influence overall credit conditions. Now, today, people think of this power of central banks as a good thing. They imagine that central banks employ this power to counter a tendency for credit shortages to develop, or sometimes for inflation to develop. But actually, a historical perspective suggests a very different view, because what really happened was that the monopoly powers that central banks had made them a destabilizing presence, very destabilizing. And the history of the modern business cycle actually begins with central banking. It doesn't end with it. It starts with privileged central banks using their powers to create excessive amounts of credit, quite often generating booms that then lead to crises. Well, whenever we talk about a regulatory solution to some problem, it's essential to ask what regulations were in effect while the problem was still happening, and this is certainly the case with respect to those crises that were taking place in the years leading to 1913. As a matter of fact, the U.S. banking system was regulated before the creation of the Fed, and it was regulated in very important ways, and in ways that unfortunately made it artificially crisis-prone. Now, every one of the crises that happened before the Fed was established had its own unique causes and characteristics, but operating in every case where certain legal restrictions on the conduct of banks, whether they were state-chartered banks or so-called national banks, that hampered them by making them weak and by making them inflexible. So, first of all, it's important to realize that we had laws almost since the very start of the Republic, whereby most banks could not have branches. The vast majority of banks were single office banks, so they had no geographic diversification. They couldn't even, in most cases, branch within state lines. So banks in the United States, on the eve of the Fed's establishment, were very small for the most part, very undiversified, and therefore very weak. The other fact that was important was that state banks during the Civil War had lost their right to issue currency completely. The only banks that could issue currency then were the new national banks. But a Civil War era rule designed to raise revenue for the war made it so that these banks could only issue currency if they bought U.S. government bonds to back the currency. Again, this was for the purpose of generating a larger sale of bonds and helping to pay for the Civil War that way. Unfortunately, in the years following the Civil War, the U.S. government was running budget surpluses, and as a result, they were able to retire their bonds. As the supply of bonds became smaller, the national banks found it more and more difficult profitably to issue currency. At the same time, the country was growing, and there were also more extreme demands for currency every year to move the crops. So as a result of the inflexible supply of national bank currency, which was the only legal currency that could conceivably be augmented, we had these currency crises. People called them currency crises or even currency shortages at the time, because that's one of the things that they involved. There wasn't enough currency, and the shortages caused a scramble for funds and a tightening of credit as banks found that their reserves were being withdrawn. And this was one of the main causes of all those panics. So when you combine the small, underdiversified nature of your typical pre-Fed bank with the inflexible supply of currency that would lead to panics with runs on banks to withdraw reserves, you have all the recipes for major financial crises. On the other hand, you have a situation that suggests that if banks could have branched, and if they were freer to issue currency without special regulations, you wouldn't have had crises. Well, we can test that, because across the border in the north, we had Canada. And in Canada, those regulations were lacking. Canada had nationwide branch banks, and they could issue currency based on general assets. Canada had no crises, none. None in 1884, none in 1893, none in 1907. And Canada, I hasten to say, had no central bank either. So when the Fed was established, it was established really as a second best substitute for deregulating our banking and currency system. People had proposed laws to deregulate, but for various reasons, all political, none of them having to do with basic economics, those measures didn't pass. They couldn't get through Congress. And so in the end, the solution of the Federal Reserve was latched onto as an alternative, more politically appealing, especially to the Wall Street bankers. And that's how we ended up with this agency that at first was conceived as one that would have special privileges to issue notes that could supplement the notes of the national banks when they were unable to issue notes because of the regulations that impeded note issue on their part. So that's the background behind the Fed. It was not a necessary or even ideal solution to the U.S. crises. Those crises were themselves caused by bad regulations, and the best solution would have been to get rid of the bad regulations, but we didn't do that. So this goes back to the restrictions on branching that I mentioned. Because banks, for the most part, couldn't branch, they were not able to access what was, by the last half of the 19th century certainly, the central U.S. money market, which was in New York. That is, they couldn't access that market directly by simply establishing branches in New York. As today, of course, that's what banks do. But they weren't allowed to in the past. So the alternative was for a bank that was not a New York bank to deal with a correspondent bank in New York as a way of putting funds in New York. So when it was the off-season in the countryside, when there was no harvesting going on, excess funds from the countryside would be deposited in some New York bank that was acting as a correspondent for the country bank. New York bankers, of course, benefited a great deal from this correspondent banking business. And for that reason, they were opposed to any legislation that would allow branch banking, which would have given banks an alternative way to come into the New York market. That's why when measures were proposed in Congress to create a Canadian-style system based on branch banking and freedom of note issue, Wall Street bankers were among those who adamantly opposed the changes because they wanted to be able to keep the correspondent business. As you might expect, it was true then as it is today that they had very powerful influence in politics because of the resources they commanded, which allowed them to lobby heavily for measures they favored and against those that they did not favor. And in this way, they played a powerful role in preventing deregulatory currency reform from being implemented and in steering reform instead in the direction of the Federal Reserve System, which was a compromise that wouldn't have hurt their business so much and might even ultimately help them, as it has been helping them, especially in recent years. Well, actually, that belief isn't hard to explain because officially the Fed is a private institution. It's actually owned by other banks, technically. That is, the member banks of the Federal Reserve System, which includes many, not all, but many commercial banks, are shareholders. They don't, however, enjoy any of the usual privileges shareholders in other companies enjoy. They don't dictate how the central bank is managed, how the Fed is managed. They have no real say in monetary policy. They are simply nominally the owners of shares in the Fed. But this nominal private ownership of the Fed really is but a superficial thing. In actual fact, the Fed operates practically as a government agency. The people who really make the decisions are appointed by the government, starting with the chairman. The heads of the various Federal Reserve banks serve on the board that makes monetary policy decisions, for the most part, on a rotating basis, with the exception of the president of the Federal Reserve Bank of New York, who always serves. And so through the government's influence on, first of all, the legislation that is responsible for the Fed's existence, and in appointing the chairman of the Fed, what we have is essentially a government agency and not a private corporation in the usual sense of the term. So yes, the ownership is nominally private, but we are not talking about private enterprise in any standard sense. Well, I should say two things in prefacing my answer to this question. One is that this is a question that I and two colleagues have devoted a lot of time to trying to answer in a recent working paper. And it's not an easy question to answer because it involves counterfactuals. It's certainly not easy to say exactly what the pattern of fluctuations in the U.S. economy would have been if there had been no Fed. And answering the question, of course, requires some assumption about what institutional setup there would have been instead. However, one can at least compare the overall performance of the economy in the years after the Fed was founding to its performance before, to ask a slightly different question, which is, are we more stable since the Fed was created than we were before? And the answer is, we aren't. Now, the answer depends also on what period you focus on. Certainly, if you include the period of from 1914 to 1945, there's no question that the overall performance of the U.S. economy in terms of cyclical stability has been worse since the Fed's creation. Now, a lot of that is due to the Great Depression, which was a period of remarkable instability. But what's more surprising is if you merely compare stability after 1945 with stability in, say, the 30 years before 1914, if you just compare those periods, there has not been any market improvement in the business cycle. The most recent statistics, and there have been important modifications in the measures of GNP for before the Fed's creation in recent years, these most recent statistics suggest only very, very slight stabilization or a slight improvement in stabilization since World War II. And that's remarkable because there's a lot of, there are many factors which one would think should have led to greater stability, even setting aside the question of the monetary system. For example, government is known to be a stabilizing factor in the economy because the government doesn't suffer from the business cycle. So other things equal, if government gets bigger, you would expect the overall business cycle to have a smaller amplitude. That doesn't mean your economy is healthier. It might not grow as fast with big government, but it shouldn't show as much cyclical behavior. Well, the government is about 5 times as big in real expenditure terms today than it was in 1914. So you would have expected from that alone a big improvement in real stabilization. And yet, as I said, it hasn't improved much at all. If big government hasn't made us more stable, it must be because something else is making us less stable, and that could well be the monetary system we've embraced. Could be. Well, the easiest criterion to use in judging whether the Fed has been a success or failure is the purchasing power of the dollar. Not just how it has behaved in an absolute sense, but with how predictable its changes have become. Because, and the reason this is a safe criterion to use is because many factors affect the stability of output. But when it comes to the purchasing power of money, the central bank bears a clear responsibility and has the power, an unquestionable power, to shape that purchasing power, to control it, to manage it. So if the Fed could accomplish any of the missions assigned to it, surely it should have been able to accomplish that of stabilizing the purchasing power of the dollar. And it has utterly failed to do it. It's failed not only in the obvious sense that the purchasing power of the dollar has declined extremely rapidly since the Fed was created, whereas it was very stable in the long run, certainly before the Fed was created. And not only because most of that decline has taken place since we went off the gold standard, which is to say since the Fed's powers to manage the purchasing power have increased, but you can also show statistically that the price level has become much less predictable since the Fed was created. That is, it isn't just a question of the purchasing power eroding in a predictable way. It has become harder since the Fed was established, much harder to predict where the price level would be in 50 or certainly 100 years than it was before the Fed. And that lack of predictability has a very decisive effect on investment, because it makes it harder for entrepreneurs to be able to plan on future changes in purchasing power of the dollar, in making their investment plans. And one of the concrete manifestations of this change is that whereas before the Fed was established, it was actually quite common for companies, railroad companies and other kinds of corporations to issue 99 or 100-year bonds. That market virtually disappeared during the Fed's period of operation as it became more and more risky to either issue or purchase such securities. And now such securities are almost unknown. Unfortunately, one can't say with any great conviction that in taking the steps it's taking recently to address the debt crisis, the Fed has stepped out of its mandate. You can't say that precisely because that mandate itself is ambiguous to the point of being almost meaningless. It's hard to conceive of any action that the Fed might take that it could not claim is aimed at either combating unemployment or business fluctuations, or at stabilizing the dollar, because they can always claim, as they are doing in the present case, that without action on their part to, say, rescue the European banking system, we would have a financial crisis that would ultimately lead to a major increase in unemployment or a deflation. So the so-called dual mandate isn't much of a mandate. It's by being a dual mandate, it becomes an almost completely open-ended mandate. Of course, after the fact, one can question the Fed's actions and say, well, did this really satisfy either of the components of the dual mandate? But the dual mandate doesn't really amount to a mandate in any meaningful sense of restraining the Fed's activities. And I think that the Fed could therefore justifiably claim that its actions are consistent with the dual mandate. Well, that's fine, but it should be a reason for everyone to realize how useless that mandate is. The ECB, pardon me, is in a more difficult situation because it has only the single mandate of controlling inflation. I think it's much harder for ECB authorities to claim that the actions they're taking are consistent with their mandate, which is a much more well-defined mandate. That's quite apart from whether any of these actions will ultimately make the European economy and the world economy safer. That's a different question, of course. I think that the central bankers in both Europe and the United States are deluding themselves if they think the kinds of actions that they've been taken can actually prevent the debt crisis from, first of all, from ultimately becoming a default, leading to a default by Greece and perhaps by some other countries. All they can do is delay default, and I think that delaying it in the wrong way could ultimately present us with problems with a monetary environment that only compounds the damage done by default itself because it confronts us with more inflation. Well, first of all, I think it's very important for people to be contemplating alternatives to the Fed. One of the reasons why I think we have to evaluate its record is to make ourselves aware of the fact that there's no reason for assuming we couldn't do better. That is, whatever you can say about the Fed's performance, it certainly hasn't ushered in an era of overall a very stable economic activity, even putting aside short periods that seemed to involve stabilization. It doesn't seem to have solved the problems that we've had in the past, and it does seem to have introduced new problems of unstable purchasing power. So surely we should be looking at alternatives. And one of the things that troubles me a great deal is the complacency that economists show when it comes to the existing arrangements. Despite all the problems we've had and all the problems we are facing, most economists seem to think that we're doing the best we can, and I find this absolutely stunning. Stunning. Are there alternatives that conceivably could be better? Yes, I think there are. I mentioned the Canadian case, and it is relevant because it suggests that even in 1914 there was an arrangement that could be much better than either the U.S. arrangement on that date or the Fed that followed it, because Canada also did better in its monetary system in the 30s than we did, and it's done better recently. So Canada's we should take Canada seriously, both in its pre-central banking period, it had adopted a central bank in 1935, and in the post-central banking period. Now, unfortunately, the Canadian system of 1913 depended, like most monetary systems at that date, on the gold standard. I say unfortunately not because I think the gold standard was a bad thing. I think it was a very good thing. What's unfortunate, though, is that it's a good thing that would be very, very hard to recreate today. One of the problems that perhaps I'll leave it to this one problem is that the gold standard that worked so well prior to World War I was a truly international standard, and that was, I think, one of the secrets to its success. It wasn't just one country that was using it. It was many countries that were on a gold standard basis, and this contributed importantly to the stability of that arrangement. So we couldn't recreate that stability by adopting the gold standard unilaterally in the United States. It would have to be some kind of multinational effort, and I don't see how that could happen. So today, when we think about stability and alternatives to the Fed, I think the prudent course is to imagine reforming the present dollar standard without trying to revert to a gold standard or other commodity standard. And this ultimately means imposing strict rules. Now, monetary rules have come under some criticism because of their association with more naive rules like having the money stock grow 3% per year, which at one time might have worked very well. At the time when Milton Friedman recommended that rule, I think it could have worked just fine. But because his advice wasn't followed, the environment has changed. But we also now know about better rules, one of which is the idea of targeting nominal GDP, which is the total dollars spent per year in the economy. That, I think, is a very sensible macroeconomic rule. It's not hard to implement. However, if we really want to have it work, we have to have it be a strict rule. There's actually no good that central banks can do except to stabilize the flow of spending. So there's never an overall shortage of demand or too much demand for goods. A shortage creates recession, too much creates inflation. And so stabilizing demand should be the real mandate that we impose on central banks. But if it's to work, it has to be a mandate that cannot be easily violated. And what I would like to see is a reform that does that, essentially by handing over the Federal Reserve to technicians. I'd rather have a technocratic Fed where the technocrats had a very strict job they had to perform, instead of a Fed run by economists who think they can always solve the problem in a better way each period, which results in erratic, unpredictable, ad hoc policy that's often unsatisfactory. But technocrats actually aren't the best solution. Technocrats are better than economists because they won't put their 2 cents in. They can be hired just for the purpose of following a rule. But better still would be a system, another idea Friedman had that today makes a lot more sense, of having the whole thing done by a computer. And this is where Bitcoin comes in, believe it or not. Now, Bitcoin has its problems, but one of the things that fascinates me about Bitcoin is the idea of creating a computer algorithm, such as Friedman recommended for the Fed, right? But a computer algorithm where you throw away the key, and no one can then interfere. So now imagine that we have this computer that adjusts the growth of the amount of Federal Reserve dollars in the system according to a rule feeding back from what's happening to total spending, and no one can change it. You start it up, you throw the key away, and now you have somebody there who makes sure that the computer doesn't get any viruses, like our computer maintenance people. I call this kind of system a quasi-commodity money system, because although the money isn't a commodity anymore, it's not something naturally scarce, it becomes like a quasi-commodity because it now has a scarcity that human agency is not able to mess around with. And in that sense, its scarcity is real. Because now once you can't get the key, you can't make any more than the computer program allows. Anyway, I just propose these things as some of the sorts of ideas that I think deserve more exploration. I also am, of course, an advocate of freeing up the banking system. We have branch banking now, thank goodness, 100 years too late. And that's great. But our banks need to be able to be free in other respects, including issuing alternative currencies without any special regulations. But finally, we'll never have sound banking as long as we have bailouts and deposit insurance, both of which I think need to be dramatically rolled back. Government guarantees are now a major source of rottenness in world banking systems, but in the U.S. banking system in particular. until we do something about these guarantees, we won't have sound banks. I think the best thing to do would be to erect a kind of two-part banking system where if a bank wants to take advantage of government insurance, its investments and interest payments will be strictly regulated as they were in the early days of deposit insurance. On the other hand, if a bank is willing to operate on an uninsured basis, then there should be no restrictions put on it. Now, there have to be devices in place to prevent people from moving money from uninsured to insured deposits and getting immediate insurance. That could cause some problems, but there are ways that that could be handled. So, freedom for banks, no government guarantees, a quasi-commodity money run by a computer and aimed at managed automatically to stabilize total spending. To me, these are the ingredients of a sound monetary system. Oh, and no Federal Reserve chairman or FOMC equipped with the power of making ad hoc changes to the monetary regime.